Okay, let's jump straight into this explainer. If you're an executive trying to forecast demand right now, or trying to understand the actual health of the American consumer, I'm willing to bet traditional economic models are kind of steering you wrong. Today, we're going to unpack the stark disconnect between record high markets and a completely tapped out consumer base, and figure out exactly why that's happening.
Here's our agenda for today. 1. The Great Economic Disconnect. 2. From K-shape to E-shape. 3. The Rise of Survival Debt. 4. The Passive Investing Trap. 5. The SpaceX Case Study. And finally, 6. Two Worlds, One Economy. Let's get right into it.
Section 1. The Great Economic Disconnect. Macro highs versus micro reality. So, the core paradox we're facing today is that traditional indicators scream unprecedented wealth, right? But consumer sentiment is somehow worse than during the 2008 financial crisis. On one hand, you've got the stock market hitting record highs and average 401k balances breaking the $160,000 mark. Awesome, right? But on the other hand, a staggering 55% of Americans say their financial situation is actively getting worse. Both of these economic realities are entirely true. They are just being experienced by completely different Americans.
And the data here perfectly illustrates the stress happening underneath. As those average 401k balances hit record highs, penalty-incurring hardship withdrawals have literally tripled since the pandemic. People aren't cashing out early to buy boats, you guys. 36% are doing it just to avoid foreclosure or eviction, and 31% are pulling from retirement to cover medical expenses. That is the grim micro-reality sitting right beneath those macro highs.
Section 2. From K-shape to E-shape, the structural divide.
Okay, so as an executive, you've probably relied on the K-shaped recovery model for the last few years, this idea that certain industries went up while others went down. Well, you need to update that model. It's no longer accurate. The divide isn't by industry anymore. It's strictly by ownership. The top 10% of households hold an overwhelming 87% of all stocks. Meanwhile, the bottom 50%, teachers, nurses, bus drivers, they own just 1% combined. Asset inflation is functionally skipping the bottom 90% of households entirely. When you put the numbers side by side, the scale is just impossible to ignore. Let's say the market returns 16% in a year. The bottom half of the country sees a paper gain of about $2,000. But for the top 10%, that exact same market return hands them over $96,000. So yeah, maybe market participation was democratized, because 58% of Americans do own some stock, but the actual dollars absolutely were not.
Which brings us to the crucial point. The true shape of the economy today is an E. Think of it like 3 horizontal bars. The top bar is stretching rapidly outward. That's the top 10% watching their net worth just explode through asset inflation. The middle bar? It's tilted downward because 3.8% inflation completely ate their 3.6% wage gains, forcing the middle class to trade down. And that bottom bar? It is completely flat on the floor, fighting for scraps.
Section 3. The Rise of Survival Debt, Financing the Floor.
Let's take a closer look at how that middle and bottom are actually getting by. Credit counseling networks are flagging a really disturbing shift away from discretionary borrowing and straight into what's being called survival debt. We are not talking about putting a luxury vacation on a credit card. This is financing used strictly for day-to-day living expenses and basic necessities. It's debt taken on just to keep the lights on. $1.25 trillion. That staggering figure is the current U.S. credit card debt. And when you factor in a roughly 23% average interest rate, you really have to ask yourself, how long can a consumer realistically use incredibly expensive capital just to fund their basic existence? These numbers prove that consumers are not in a position of strength. Over 65 million households in the bottom 50% are running a negative savings rate. That means they spend more than they bring in after taxes every single month. The overall personal savings rate has dropped to a near-record low of 2.6%. And get this, over 25% of buy now, pay later users are using it to finance the weekly groceries. Plus, 61% of credit card debtors have been carrying balances for over a year. If you're an executive analyzing consumer demand, this is a massive flashing red flag. Your consumer is running out of runway.
Section 4. The Passive Investing Trap, the Hidden Bridge.
Let's look at how structural market mechanics actually link these two vastly different worlds. We were all sold passive investing as the ultimate financial democratization, right? Low fees, set it and forget it. But that convenience comes with a huge hidden cost. It automatically forces middle-class capital to buy whatever gets added to major indices, completely without your input.
Or, as portfolio manager George Noble so bluntly puts it, your 401k is the exit liquidity.
So think about this for a second. If the average American is fundamentally broke, relying on survival debt, who exactly is buying unprofitable companies at record $1.75 trillion valuations? This brings us to a massive systemic transfer of wealth that is happening right under our noses.
Section 5. The SpaceX Case Study. Engineering Market Demand.
We can actually see this hidden bridge perfectly illustrated by looking at the upcoming historically massive SpaceX IPO. $1.75 trillion. At this reported target valuation, SpaceX would be worth more than every single American defense contractor combined. Literally worth more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks put together. To even begin to justify that price tag, we have to look under the hood.
SpaceX is essentially three businesses stacked into one. You've got Starlink, which is printing cash beautifully with accelerating 63% profit margins. You've got the rocket division, a steady core business. But then there's the massive anchor. Through an internal all-stock merger, SpaceX acquired Elon Musk's AI company, xAI, for $250 billion. The catch? xAI is burning an estimated $1 billion a month. So when you combine that cash-printing crown jewel with the massive AI anchor, the consolidated company actually ran a net loss of nearly $5 billion last year. So here's the $1 million, or rather $1 trillion question. How do you get public markets to buy a company losing $5 billion a year at a $1.75 trillion valuation? Well, you change the rules. To make absolutely sure that over $600 billion in passive index funds are forced to buy this unprofitable entity, NASDAQ completely rewrote their rulebook. They adopted a new fast entry rule just in time for this IPO.
The mechanics of this forced demand are wild. First, they cut the standard wait time for index inclusion from 3 months down to just 15 trading days, completely stripping away necessary price discovery. Second, they eliminated the rule requiring a minimum 10% of shares to be publicly available, which perfectly accommodates SpaceX's tiny 4 to 5% float. And third, they applied a hidden multiplier, legally requiring ETFs to treat that tiny float as if it were 3 times larger. By doing all this, NASDAQ essentially manufactured guaranteed automatic demand from index funds.
Section 6. Two Worlds, One Economy, the Systemic Conclusion.
What we're looking at is a highly engineered market event that seamlessly merges the struggling consumer with the soaring ownership class. SpaceX's CFO stated they're targeting a massive 30% allocation specifically for retail investors, way above the standard 5 to 10%. Why? Because retail investors and middle-class 401ks are being deliberately targeted to absorb these shares at peak valuations. Insiders get unlocked so they can sell, while regular Americans are mechanically forced to buy via their passive index funds. And the crazy part is, SpaceX is just the beginning. This new rulebook opens the floodgates for other tech giants like OpenAI and Anthropic to run the exact same playbook.
Which really brings us full circle. As an executive planning for the future, I want to leave you with this to consider. The financial market actively relies on the middle class to automatically buy the top via their retirement accounts. But as the micro data clearly proves, that very consumer is currently surviving on credit and running a negative savings rate. So what happens to the top of this E-shaped economy when that well of foundational exit liquidity rapidly runs dry? Thanks for joining me on this explainer, and I'll catch you next time.